We see the German market up 12% in a month. We see the U.S. NASDAQ up about the same in a month. It's been quite a violent rebound. There's been some hope about this reopening talk. Do you believe the market's maybe overpricing in the rapidity of getting, quote, back to normal?
Absolutely. I think the first thing is there's a difference between reopening and restarting and growth. So absolutely, we're moving from a total standstill to a gradual reopening with a lot of restrictions. We had the example of Starbucks, but you can't go in. It's going to be limited hours. You have to pick up your order. So it's great that we're restarting, but the level of growth we're going to get from that is not at all anywhere close to what we had pre-crisis. And when you look at the recovery throughout the month of April in markets, it's pretty much pricing in a seamless transition from crisis to post-crisis. And we think at some point it's going to become a little bit bumpier than what's priced in today.
In other words, you think the stock market rebounded too far, too fast?
Too far, for sure. Now, given the strength of the recovery, the rebound that we've seen, we might not retest the lows, but we're definitely pricing in a little bit too much optimism. And I mean, it'd be difficult to imagine that a 3-week correction would be the end of it for a crisis that's brought the global economy to a complete halt. So I think that that's sort of one of the aspects, but there's so many questions that remain. Are we going to get a second wave? Are cases going to start spiking as we deconfine? Are we going to just continue with this social distancing for a very long time, which means we don't get back to pre-crisis levels? And we're just at the beginning of some of these bankruptcy announcements, which means we don't know the full extent of the damage. We don't know what the starting point is really going to be. So we're tentatively reopening in May, but we don't know all the figures yet. And I think at some point we're also maybe underestimating how high unemployment might remain for a long time and what that impact could be on U.S. consumers.
Yeah, and it's interesting, Esty, because we know that history suggests that almost every bear market has had, a violent reversal. You can go back to great, financial crisis, the internet crisis, go back even further, where you get this big drop, a violent snapback, and then kind of a period of a slow decline. But in those periods, we didn't have 5, 7, maybe $10 trillion of U.S. Federal Reserve and Treasury support. How does the government backstop, hurt or, I guess, work its way into your analysis about this market at all?
I mean, the stimulus has been massive, and it's one of the big differences for the past. Policymakers have clearly learned that you have to be proactive and aggressive. They didn't wait as long. They were much quicker to pass stimulus. The Fed in particular, I think, has been an example of pretty much covering every angle it can within the bond and funding markets to help ease this, and it definitely helped bring back confidence. Now, some of the fiscal measures at this point are income replacement or relief. It's not actual stimulus. We need to see how it's deployed. We need to see if it's deployed fast enough. But that definitely does change the picture. The other part is exactly what you've said, is we've always had a second leg or third or fourth leg down. And the risk, I think, is that it's almost a little bit consensus to expect another leg down. And that's also why, it might be milder than we think. But when you look at the reality of the fundamentals today, and you even think 3 to 6 months out, the picture is just not going to be all clear, I think. And at the moment, the markets are pretty much saying, doesn't matter what happens in 2020, let's focus beyond that. But I think some of the realities of 2020 still need to kind of get priced in.